So you look at the market reaction today, stock market reflecting jubilation, optimism, the bond market, alarm. How would you characterize this reaction to the election outcome?
Saying to your clients is, this is what happens when there's a lot of uncertainty. People brace for the worst, and then they breathe a sigh of relief. I mean, the S&P is up about 2.3% today, which would be the strongest post-election day reaction we've seen since my data started in 1950. People are definitely reacting, maybe celebrating, maybe bracing for more after, what we saw last night. And it seems like there's going to be a lot of change underfoot. I mean, what we're looking at right now is a Republican sweep across the Oval Office in Congress. So these policies that have been talked about for months now could actually happen given the makeup that we could be seeing in Congress.
Yeah, and you note that the market's first reaction to this Trump presidency 2.0 has been to believe everything. How long does this last, given the lofty valuations we have in the current market?
Well, we have to remember the Fed is tomorrow, so there's always something that's going to distract us. I mean, one thing to think about too is that, markets tend to have knee-jerk reactions to emotional events, and I think we could characterize this as an emotional event, at least based on my social media feed. But the knee-jerk reaction isn't always correct. And Scarlett, I think that the market may be overlooking some of the risks that come along with these policies. First of all, we don't know if Trump will be able to enact most of them, although, I mean, we could go down the list one by one and talk about all the policies that he's thrown out there. But also, and I think the bond market is considering this a little bit more than the stock market, but, we see risks and trade-offs to consider here. It's not just, gangbusters growth that means everything goes up. I mean, you're even seeing break-evens today showing that there is the risk of higher inflation. So, the knee-jerk reaction isn't always the right reaction, and we're worried this might be the case this time around too.
Yeah, because even the time involved, Callie, right? I mean, there are 2 months before even the inauguration happens, and it's only at that point that he can even sign executive orders or whatever he might be able to do quickly, and that's not suggesting that he's going to carry out any of this via executive order. Could the market, though, continue to hold on to these highs for that lame duck session?
Whenever I'm confused by the headlines, Vonnie, I like to think back to fundamentals. And I think any analyst on Wall Street will tell you that. I mean, right now, the job market's weakening. Of course, this election could change things in the way of policy, but there is still a lot of good things going for the market at the moment. I mean, we're telling clients to still prepare for a drop here because, of course, if the job market does continue to weaken, then we could have some issues on the unemployment side of the house. And bonds, I think, could still act as good portfolio protection. I know rates are a little bit higher, but we're urging clients not to think of them as these income generators that they've seen over the past year or so. So, I think the fundamentals point to what could be a higher market ahead. Then again, I mean, the market's up 2.4% today. Things look a little frantic, and in frantic days, you see big up and down moves.